Look, good afternoon and happy World Soils Day to everyone. Let's celebrate this very important resource on our land and on our planet, and today learn more about soil carbon in the ag landscape with this latest Landcare farming webinar, which is titled Maximising Ecosystem Opportunities to Fit Your Business, Carbon. Now, this is the second of these webinars. A lot of you would have been on 12 months ago, nearly exactly, when we ran the first of these webinars with nearly exactly the same panel. And so we've been lucky enough to be supported by these fabulous very smart people that are working in this world of carbon as it applies to agricultural land. My name is Ange Hammond and I manage Landcare Farming, which is a collaboration between the National Landcare Network and Landcare Australia. And our program is designed to support primary producers all across primary production industries in Australia and across all regions in Australia. We've been lucky enough to work with this group of presenters that will be presenting to you today, and they're leading agricultural industry professionals, and they are supporting us once again on this webinar. Look, this is an opportunity to update on last year's information, and if you weren't here last year, I'm sure you've been involved in this soil carbon world over the last 12 months, 2 years, and it's a very ever-changing landscape. So this is an update with some important and relevant and updated information. So any questions you have during the webinar, please put them into the chat and we will deal with them in our discussion at the end. We will be recording this webinar and we will send that to everyone that signed up for the webinar, and plus we'll put it on the Landcare Farming webpage. So if you've got any colleagues that couldn't attend today, the webinar will be available and we'll send it to you so you can send it to them. Look, with no further ado, I will hand over to our excellent panel of presenters so that they can empower you on your journey into furthering your understanding of farm carbon accounting and emission reductions options. So our first speaker today is Dr. Richard Eckard. I'm just going to give a little brief on each speaker, very short. You could write pages about each of them, but Dr. Richard Eckard is a professional of sustainable agricultural systems at the University of Melbourne and director of the Primary Industries Climate Challenges Centre, which is a research centre addressing the impacts of a changing climate on agriculture. His research focuses on carbon farming and accounting towards carbon neutral agriculture, managing extreme climatic events and options for agriculture to respond to a changing climate. So without further ado, Richard, I will hand over to you. Thank you.
Thanks, Ange, and hopefully everyone can see the screen and hear me. I'm starting off just with a bit of a preamble on what's happening in the carbon landscape and a bit of an update. Some of you might have heard some of this before, but it's an ever evolving landscape at the moment. So before we get into the technical stuff, let's understand the landscape we're dealing with. As a lot of you would know, there's a COP meeting going on right now in the UAE. Very interesting place to have a COP meeting, given that all the big oil companies are right there. You look out the window of the COP meeting and there's crude oil flares going on outside. You wonder what's going on there because, well, all of them are sitting there to agree to not have any more flares outside the window. But anyway, that's where it is. COP21 set us on a pathway towards the Paris Agreement, which most countries have now signed up to. And the aim was to have a world under 1.5 degrees, which looks increasingly unlikely right now unless we increase ambition, but also to achieve a balance between emission sources and removals. And that's where the whole term net zero comes from. Can we net out that sum game? And that's really important for agriculture to understand that the net zero world is coming our way. So that plays out into the carbon credits space. And COP26, the Glasgow Agreement, increased short-term ambition. And as we know, with the current COP meeting, there's an entire day focused on agriculture and how we treat agriculture and agricultural emissions. So really important for us. But what we've seen in response to the Paris Agreement is a very dramatic response by the multinational supply chain companies. And I've kind of gathered them up here. So you've got a dairy composition in the top left, and you've got beer and banks and chemical companies. We could go on forever, but these are all companies in our supply chain that have set targets using the Science-Based Targets Initiative. And the Science-Based Target Initiative is aligned with the Greenhouse Gas Protocol, which is IPCC. So all the discussion around changing metrics that we align to come unstuck when you realize that the supply chain are using the Science-Based Targets Initiative for their targets. They're not going to accept other metrics for greenhouse gas emissions accounting. And in response, we've seen a number of companies starting to say, well, can we be proactive in this march towards neutrality? Now, I've just picked a ever-growing list. Even today, I updated this list with some more livestock and wine companies aiming for carbon neutrality. Why do I present livestock and wine? They're at the opposite ends of the spectrum, and they're at the opposite ends of the challenge. Wine, 90-something plus % of their emissions are from diesel and electricity use in a bottle of wine. So, you know, I glibly say plant 2 trees and you'll be all right, and go on to renewable energy. Whereas livestock, if you're in Northern Australia and you've got thousands of head roaming around that you don't even know where they are, it's a different challenge. And we have to recognize that the different challenges do exist. But we do know how those supply chains are going to start moving towards their targets. So they've set targets, and I have very surreal conversations with some of these companies where they say to me, we set a target, can you help us on how we're going to get there? And slowly what we've seen is the companies starting to say, well, it's going to be a shared journey, but we're starting to understand how this is going to have to operate. And we can see it happening with some of the major supermarket chains, with some of the wine buyers. Sorry, there's a helicopter going overhead. But the basis on which they buy, I've got that example on the right, which says we'll end up with a carbon audit done on the property, and the carbon audit will end up with a result of tons of emissions per ton of beef or tons of emissions per litre of wine. And then it's pretty obvious, if you are a company that has set a net zero target or a 30% reduction target by 2030, that's the basis on which you can buy. So if you are a beef producer wanting to supply carbon neutral meat to a major supermarket, why would they buy you if you're a 25 when they can buy a 10 or an 8? So they buy the 8s and the 10s first because, well, it costs them less carbon credits to achieve neutrality than if they buy you as a 25. Now, is that a bad thing or a good thing? Well, actually, in the interim, it re-empowers us as the agricultural suppliers, because what it means is that current best practice matters. If you get your weaning rates right up, I mean, how do you change from a 15 to an 8? Well, you go from 60% weaning in a beef system to 80% weaning, and that's how the number drops. That's why prime lamb always looks better than beef, because you're getting 1.5 lambs per ewe. So you're dividing by 1.5 instead of 1 in a beef system. So typically, prime lamb can go to 6, for example, as their sort of better emissions intensity. So I think we should see this as a positive in that it's while the industries have got a carbon neutral strategy, like CN30, you as a beef producer or as a lamb producer or as an agricultural producer can move towards a lower emissions intensity as the first step. And then later on, when technology comes through to feed your cows on something to eliminate methane, you do that as well, and that number goes further down. I hope that's clear, but it gives us something to do tomorrow, which is about being at the head of the queue by being the most efficient farmers we can today. The other thing I'd like to emphasize is I was part of this Net Zero Australia plan that the University of Melbourne, Princeton University, and the University of Queensland put together. And my job was the land sector reconciliation. In other words, how does the cotton industry move towards neutrality? How does the livestock industry move toward neutrality? What are the key planks and technologies? And the one thing this told us is that the agricultural sectors in their own right are going to struggle to get net zero with known current technology or projected technologies, things that are on the horizon. We're going to struggle. And so it knocked on the head this notion that we've got all these spare carbon credits out there that we can sell to the big emitters. Because what this plan told us is that if agriculture kept all its own carbon credits in its own soil, in its own trees, and we inset those towards our own supply chain requirements, we still struggle to get to the net zero target of 2050. And so it really reset our thinking to say the world needs to move from, agriculture needs to move from this, we're going to offset and sell carbon credits for short-term gain, to we're going to inset, we're going to keep our carbon in our own soils, in our own trees, and we're going to inset it towards our own supply chain access, because that's our main game. If we lose sight of selling beef or selling cotton or whatever we sell, you've lost the plot. So it changed our thinking from an offsets mentality to an insets mentality. What's the difference? Well, an offset in traditional sense in Australia, you would generate an Australian carbon credit unit, and you would accumulate those and you would sell them to the big emitters, because those big emitters are now under a squeeze under what we call the upgraded safeguard mechanism. So all the mining companies have to reduce their emissions every year, and so they are on the hunt for carbon credits. But if you do sell those, if you sell soil carbon or tree carbon, then that's gone. It's an asset sitting on your farm, but it's gone to the mining company who will use it for their emissions. And so you can no longer use that to access your own supply chain. If your supply chain says, we want you to be 30% less, you should have kept those, no, shouldn't have sold them. As opposed to an inset is keeping the carbon in your soil, in your trees, not monetizing it, not generating an ACCU, just doing an audit, and some of the later speakers can talk about that. And you're keeping it and you're socializing it along your supply chain to make sure you can meet the supply chain targets. And so what we see is between now and 2030, we see early movers, like the ones I showed you on the screen, or the Jigsaw Farms example I've often spoken about, trying to be at the front of the queue and getting premium prices for wool, grain, wine. We're seeing those prices are being paid for carbon neutral wool, for example, and wine. But you'd have to argue that once we're all reached to 2030 and those supply chain targets all kick in, then everybody's got to be 30% less emissions to actually sell down the supply chain, or else it's going to cost them a lot of money in buying offsets. And so to be at the head of the queue, you want to be insetting, not offsetting. And that's the key message that, that I wanted to get across. Now, we've got to realize that achieving carbon neutrality is maybe not the main game. What I mean by that is there's a difference between net zero and carbon neutrality. If you look at the true definition of carbon neutrality, I don't think any agricultural business has ever been there. Because what it really implies is, in the original true definition, it's management that first seeks to minimize the greenhouse gas emissions. In other words, you have to demonstrate that you have reduced your methane or nitrous oxide emissions down to an all-time low with every technology possible, and then only bring in your own offsets to knock off the balance that is intractable. So you can see that those meat companies I showed you earlier that are claiming carbon neutrality, they've just bought offsets. They haven't reduced methane. So technically not carbon neutral. Net zero is actually what they're talking about. Net zero is total of all the greenhouse gas emissions in a year minus the annual change in soil and tree carbon. If that is less than zero, zero equal your net zero. A little caveat underneath that about the annual change in soil and tree carbon, because I think where we're headed is not annual claims in soil carbon or tree carbon. It's a running mean. Something like a 10-year running average would be more fair, because it irons out climate variability influencing that annual change. So let's be aware of the difference between the two. So it gives you different profiles for different industries. So you think of dairy, for example, versus rangeland beef. Rangeland beef don't use much nitrogen. So you get proportionately mainly from enteric methane. Dairy uses a fair bit of nitrogen, a fair bit of energy, so it dilutes the effect of methane. Pigs and poultry, on the other hand, it's got nothing to do with the birds or the animals. It all comes out the back. And so it's manure management. And that's what those big slices are. If you go to rice, for example, there's a large methane component from rice because of the flooding. You've got organic material under anaerobic conditions. Now, we already know we can halve that just by not having long inundation in rice. Cotton and grains, it's really about nitrogen fertilizer. So that brings us to a listing of the kind of emissions intensity figures we're seeing coming out of agriculture. Now, I would caution anyone comparing from top to bottom. I think that's a complete furphy, because a kilogram of wool is not a kilogram of meat. And so going up and down really doesn't help us at all. But going left to right does help us see that in dairy, we can go from 8 to 21 tons of CO2 equivalent per ton of milk solids. That's a massive range, which gives room for improvement. And when you go back to that earlier diagram of mine about the QR codes and working towards a lower emissions product, it says that if you're a beef system, you can go from 18 to 11. What's the difference? Better weaning rates, better health, better reproductive performance, better genetics. All those best practices all make a difference. But it does bring us to a bit of a summary of, who can get to net zero. You'd argue pigs and poultry. It's all about manure management. You either wet it up and generate methane, or you dry it down and sell pelletized fertilizer. Dairy and feedlots, well, we know with current technology about 50% is possible today if it was economic, but it's not. Extensive grazing presents a challenge because it's accessing the animals out there in rangeland conditions. And so a far more modest outcome might be possible with better legume technology, for example. Wine and perennial horticulture, well, almonds don't produce much emissions at all. And if they didn't mulch their trees every 25 years, they might have some carbon to talk about. And then annual cropping, if we coat the fertilizer, about 50% is possible. Where I'd like to finish off before I hand over to the next speaker is just reminding us to keep the long game in mind, because right now we've got a fairly myopic focus on carbon, and it's appropriate for right now. But when I was part of developing this Australian agricultural sustainability framework, we were trying to bring about 200 frameworks from around the world into one Australian framework that can meet the intent of all the others. And we put a fair bit of effort into P1, P2, P3, which is all your greenhouse gas emissions and soil carbon and tree carbon, biodiversity. But look at which the white arrows are pointing. It very clearly says, today we focused on carbon and soil health, but tomorrow we're going to focus on biodiversity. And I do mention that because we see an example in New Zealand where, in order to get the best carbon revenue, they're planting pine trees into sheep pastures. Now, that might get you the best revenue today, but by 2030, when the world cares about biodiversity, which is coming next, well, there's not much biodiversity under a pine tree. So I guess I present this to say, let's make sure we keep the long game in mind and don't lock ourselves into something on carbon that locks us out of the next ESG, which is likely to be water resources and biodiversity. Let's keep it all in mind. And then to finish off with absolute heresy, I actually wonder if by 2030 we'll be trading these against each other. In other words, if you're a precision agriculture cropper in Western New South Wales and you've got 5 kilometres cleared for the GPS tractor, not a lot of biodiversity to talk about, but very low emissions per hectare. So we're trading the one ESG against the other. You go to the Northern Territory, where the termites are producing more methane per hectare than the cows are, but you can't do anything about it because you don't know where the cows are. Whereas you've got the biodiversity signal is actually quite strong. You've got thousands of trees, you've got thousands of budgies, you've got thousands of insects. And I can see a world by 2030 where we will say, well, for a particular product in a particular environment, this is an acceptable mix of ESGs that meet the supply chain demand. So that's my ending on heresy. I'll leave it back to Angela.
Thank you very much, Richard. Look, once again, great presentation to start this thing off and very thought-provoking. So look, without further ado, once again, I'll hand over to our next speaker, who's Dr. Warwick Badgery. Now, Warwick is a research leader with the New South Wales Department of Primary Industries with over 15 years of research experience in improving the profitability and sustainability of grazing systems and mitigating greenhouse gas emissions under a changing climate. Warwick has significant experience in investigating soil carbon under grazing systems, led the Central New South Wales component of the National Soil Carbon Research Project, and helped develop the first pilot pricing scheme for soil carbon in Australia. When I was at uni, I really wanted to go and work for Warwick, so I'm glad to have him on here. Thank you for that, Richard, and over to you, Warwick.
Thanks a lot, Ange. Look, today on World Soils Day, I'm going to talk a bit about soil carbon. With the presentation I gave last year, I went into a lot of the basics around soil carbon, but today I really want to drill down into sort of 3 key points, which are, as my presentation starts moving. So just while this is going, the key things I wanted to focus on. the key things I wanted to focus on were the change in soil carbon over time, and then the variability of soil carbon, and finally, I wanted to focus on sorry, I just lost my presentation. Can everyone see that?
We can see that, Warwick.
Okay. Yeah, no, I lost it off the screen, sorry.
Blue screen now, Warwick.
Oh, okay.
It looks like your computer's done something funny. No, we've got now your paper with the 3 dot graphs. Oh, it's gone back to a blue screen.
Okay, I think it's just crashed. So just
stop
sharing for a second.
Would you like us to see if who else have we got? Richard, Andrew might be able to fill in. Do you want us to just jump in with another chapter and come back to you, Warwick? Or
just give me a minute to reload this, and then I'll try it again. So.
No worries at all. Look, I just sent out a message to everyone too. We will send out this recording tomorrow when we've got it downloaded, but I will also send the link to last year's webinar just in case any of you want to review any of the data that was presented last year. So that will be available. And actually what we will do while Warwick's just getting that, the email we'll send out to you with the link, we'll also have the link to this morning's webinar, which was our Farm Lab soil carbon project with UQ, which is also relevant to our audience. So you'll have the recordings of both webinars at your fingertips to share with your colleagues and to look at yourself. Isn't technology wonderful? Well, this year, we're worried that Mel's computer was going to crash because Mel's up at Banana and, when you're a bit remote, the phone doesn't work sometimes and the power doesn't work sometimes. And Mel's got a bushfire at a back fence. Last year for the biodiversity webinar, which was about the same time, we had Nadia broke her leg the morning of, and so Mel Shannon had to get on. So there's always something, isn't there? Is it all working now, Warwick? We've got it, Warwick.
I think so. Just hopefully it does. I think my internet connection's a bit dicey myself, so let's just see how it goes. So the 3 key things I wanted to cover were the change in soil carbon over time, the variability in soil carbon, and just how this causes uncertainty when we go to measure it, and just trying to make sure that we put all this into context. And the third thing I wanted to cover off on was soil carbon at depth, because it's one of the most common questions that I get asked is how much soil carbon's down there? Is there something different happening at depth that isn't happening at the surface, those sorts of things. So I wanted to cover off on that. So one of the key things with the variability over time is that when we're looking at change in soil carbon, say in the top 30 centimetres, you're generally not going to achieve something like a 1% change in soil carbon in the top 30 centimetres. We're often looking at something around a 0.1, 0.2, up to 0.3% change with land management across that 30 centimetres. So they're relatively small amounts of carbon that we're trying to understand across really vast landscapes often. And this is sort of part of the challenge, is how do we get understand those small changes. Okay, it's just take a bit of time. Okay, so this is just a bit of background around what drives soil carbon change. So there's a lot of information here. So if you want the simple version, look at the triangle, which means change in soil carbon equals inputs minus outputs down. So that's the simple version of this diagram. But if you want a little bit more information, what we've got is plants are using photosynthesis to grow biomass. That biomass, a portion of that is going off as either crop or in animals and exported out of the system. And then the remaining biomass, which is either litter, roots, or goes through root exudates, is what's entering the soil as potential to form soil carbon. So then once we get into the soil, we've got a number of different pathways that biomass can go. So first is sort of it can leach into what's the DOM, which is dissolved organic matter. But generally it goes into the cross fraction and requires microbes to break it down. And it's only when the MOAM, which is the mineral associated organic matter, which is the organic matter is bound to clay and silt particles or physically protected in relatively small areas within the soil. That's the area in the soil where it's most protected and is likely to stay there. The other thing this diagram gives you is some of the ways we can measure some of these processes, but really what it comes down to is at this stage we still have to soil sample to get an understanding of the key amounts of soil carbon. And we sort of can't get away from that. So some of these other tools we can use for research capacity to understand where carbon's going and how much is going off in respiration, particularly things like flux towers, which are becoming much more common. But still, we need this soil sampling to close the gaps at this stage. We can't accurately just do this with via remote methods. So when we're looking at changing soil carbon over time, where we start from really matters. If we're starting from a high level of soil carbon, say in point A here on this graph, and you improve management, you still may see a decrease in soil carbon. But that soil carbon decrease might not be as great as if you hadn't implemented improved management. And we usually find this along long-term cropping systems because we've got this declining trend. If we move to something like higher adding extra fertilizer, retaining stubbles, then we might slow that rate of change, but we still might have a long-term decrease in soil carbon. If we've got lower levels, then sometimes with a new improved land management, we still might be having a benefit, but might be no change as is shown here by point B. But if we implement that same management change when we have low carbon, then that's when we have a potential to build build soil carbon. So that's starting with how much soil carbon we've got in, and this is very much for an environment. So environment encompasses the climate, which is rainfall, temperature, but it also encompasses the soil type that you're on. So these levels are very specific for those conditions. So this is just to give an example here. Again, this is a cropping example. If we are looking at cropping over time, we generally find we're losing a little bit of soil carbon every year with that practice, and that's as we're mineralizing organic matter that cropping practice to provide nutrients into that cropping program. But if we put in an improved management, and this is an example of a cover crop in this instance, to enhance soil carbon, what we find here is this yellow dashed line is the old practice if we had to continue to implement it, and the green line is the new practice after we've implemented. So while we still have a decrease in carbon over time, there is a potential benefit compared to if we hadn't enacted this management practice. So there is a benefit, and there should be carbon credits able to be generated from this process, but we still may not increase carbon. And so a lot of the schemes that we're working on at the moment, like ACCUs, are actually using a point-based time measurement for an individual area. So if we take these two black points and we look at the change in soil carbon over that time, even with the improved management practice, there'd be a decrease. So there'd be no way to credit carbon under something like an ACCU, even though there is enhanced benefit from improved management. So this is sort of one of the challenges we've got with these time-based management processes and some of the risks of when we go into a sampling program. So I just wanted to give another example, looking at these cases, and this is where sometimes we can have an increase in soil carbon that is occurring across all land management. So it's really an environmental driver. So that we know some of this is related to rainfall, but we also know that they're not all related to rainfall, these environmental gradients. There's sort of into specific site criteria that actually impact on what's happening at these levels. And sometimes it might be something to do with the nutrient cycling in the circle as well. So this is an example from a long-term trial at Condo. We had 12 years where it increased soil carbon across all the land managements that were there, from continuous cropping to perennial pasture. At the end of that 12-year period, there was a benefit from good management to bad to the worst management, but it wasn't as great as the increase that we'd across those 12-year period. The systems had diverged slightly, but the benefit that we could sort of attribute to the improved management was only relatively small compared to the total increase that we've seen over that period of time. The challenge with this site was that we had a decrease in carbon that happened quite rapidly from 2012 through to 2015. And there's obviously an environmental driver of this because it happened across all systems, but we couldn't put our finger on what was actually driving this. I suppose, again, the good thing here is that the benefit that was seen at before that dropped was still seen at the end, but we're working back at lower soil carbon levels, back close to where we started. And so again, if we were using something like an ACCUs where we're crediting between different time points, we probably would have had 2 time points where we would have credited for an increase in soil carbon over, say, 2 5-year periods before that 12-year period, and all land management would have really been credited with very similar amounts of soil carbon buildup. Yet once we got to that point, there's only really a benefit. And we only know this because we've monitored all the systems at the same time. But if you're going out to do this on your own farm, you generally you're not monitoring the null. You're not monitoring paddocks that haven't changed management. You're monitoring just the area where you put new management on, and you're assuming that all the change is actually related to that management activity, which it may be. But there's a lot of instances where we have these other things that are actually impacting on soil carbon change as well. And the big challenge here is if it goes down, then what happens, and where does that liability go with that carbon missing? And it depends on the scheme that you're involved with, what happens there. So the other thing that I wanted to talk about is variability in soil carbon, and this is some work from Karnika Singh did a number of years ago on a single paddock out at Warren, but I've used it just to highlight some of the issues around variability in soil carbon. So generally, we don't know how much variability there is when we go to start sampling an area, but we know most of that changes in the short range. We can often describe some of that variability by just stratifying the paddocks up. And so if we're looking at this aerial photograph here, there's some stratifications on this paddock where basically the paddock's been divided up into different zones based on things like crop yield, topography, differences in radiometrics or soil type. And this is a common approach. And when we look at things like the ACCUs soil carbon method, there's actually a requirement to have a minimum of 3 strata across a soil carbon area when it's been sampled. But then if we start looking at this is actually the variation in soil carbon tonnes per hectare in the 0 to 10 centimetres that's been mapped. So this paddock was actually sampled on a grid. We can see that there's quite a lot of variation in soil carbon. Generally, you sort of need to get out to 100 metres before that starts to even out. So sampling to measure that change, it needs to be optimized to increase the chance of detection. So just simply here on the right, we've got a graph here which shows the number of samples that are taken, and then this is the standard error. So one of the things that we need to understand is the minimal detectable difference for soil carbon, and this is really determined by how much change we expect to see from different land management practices. So generally, if we were looking at say something like just putting 9 cores in 3 strata by 3, which is the minimum for a soil carbon method, we might have a detectable difference somewhere in the order of 8 to 10 tonnes of soil carbon. If we then, say, did some nesting, which involves, say, we put 3 extra cores in, or say 2 extra cores in for each of those strata, then we might, and double the number of samples, then we might put that minimal detectable difference down to 5 tonnes. If we add 3 cores per area, it might bring it down to something like 4 tonnes. So we need to sort of optimise these strategies. And this graph on the right here gives an example of that. So if we just used a single core that was randomly taken, this gives you the standard error. So if you double that, that's about the minimal detectable difference that you might find. And then these show different size quadrants where we sampled where she sampled 8 cores from. So you can see as soon as you have those extra cores in that sampling point, it starts to bring it down. And then there's some advantage from optimizing the amount of area there a little bit further. So that just gives you an example of sort of how a strategy can be implemented. Probably the last thing I'd like to say around that is we should be, I mean, there's been a really big focus around sampling cost per hectare and trying to get that to the lowest point. And the simplest way to do that is to do less cores and less sampling. But that actually increases your error. So really what we should be doing is focusing around something that gives us enough confidence. So something like $1 per ACCU is probably better, because the current method takes into account uncertainty. And so if you've got uncertainty, then you are getting a bigger discount around the number of ACCUs that you actually get. So we can optimize this to have a lower, as low a cost strategy as we possibly can get, but it can actually maximize the amount that you, for the number of ACCUs that you might be looking at. So the next thing just to come into to talk about is measuring soil carbon at depth. It's generally more variable at depth. So I know there's been a lot of focus on measuring soil carbon as deep as you possibly can, because there's, I guess, a perception that you're taking into, there's a bigger pie that you might be able to be getting credits against. But as we move deeper in the soil, then the soil carbon that's there is actually more strongly related to the soil properties that are there and less related to the land management that actually we might be and change. The other factor that we have often when we go to depth is we get a lot of inorganic carbon, particularly when we've got high pH soils. And so while if you're using something like a LECO method, it picks up those carbonates and they're inorganic carbon, so it's not carbon that is part of organic matter, and we need to make sure that we account for those. And so when we do that testing, we often do a little drop of acid on the sample to see whether it fizzes. If it fizzes, we know we've got carbonates there, and we actually have to acid wash that sample to take out those carbonates before we test it for carbonate. And so it is something that we do see as it can be a source of error, particularly when we're looking at samples at depth. And when we're looking at spectrometry methods, we're not sure how well they might account for some of that inorganic carbon at depth as well. So I've just put this up as an example of what we might see as an expected level of change at depth. Generally, if we see a change at the surface, we do see that signal at depth, but it's generally smaller. And so often if we're going, say, down below 30 centimetres, it's really difficult to find a detectable difference in soil carbon at that depth. And there's a higher risk that you might be picking up variation in soil properties more than genuine change in soil carbon. And as an example, when we've looked at some fence line comparisons that have sort of been used as examples to say that there's sort of been something interesting happening at depth, we've found some physical properties of soil that have actually been related to the soil carbon and strongly describe that, like the gravel content at sort of 50 to 70 centimetres. So when we've started looking at these depths, we often find something like this that happens. Most of the action is in the top soil surface. We see a little bit more at depth, but it's generally small, and it is similar to the depth to what we see at the soil surface. So just in summary, change in soil carbon is influenced by the staying levels of soil carbon, which can often be related to the environment that we're measuring in. Trends from historic land management change like clearing and other environmental trends, we really need to consider those, that they could be a source of error. And this is sort of why when we look at when soil scientists are talking about this, or we've done research, we've often done the null method. So we've taken out some of that variability. Whereas if you're measuring at home between 2 points in time, then you've still have potential for that error to be part of your measurements, and they may not be part of the current management, which is what we're really interested in when we're actually doing these measurements. Change in soil carbon can be hard to detect due to the small changes and high variability. I mean, there's many instances where we've gone out expecting to see a change over time and it's not significant, or we can't detect it because the variability is too high in what we're trying to do. And so we really need to design that sampling strategy to try and pick that up and have confidence that there has been a land management change implemented that will have a change in soil carbon. And generally, the soil changes to depth are small. There's high variability, which will make it difficult to detect. So that's all. Thank you.
Thanks very much for that, Warwick. And look, can I just ask everyone to make sure their microphone's off? I can hear some background noise, so can you just check your microphones? But look, thank you, Warwick. As we all know, soil carbon's a very tricky one for the measurement of, and hopefully these projects will help to improve all of that. Our next speaker is none other than Stephen Wiedemann. He's a very respected scientist in this carbon world. He's an ag system scientist and managing director at Integrity Ag, a highly respected Integrity Ag and Environment, new name for the business. Highly respected in our industry. He's a leading expert in carbon footprinting and baselining, emission reduction, carbon offset project development, and carbon neutral certification. His experience extends across a full suite of ag industries, including wool and cotton, beef, lamb, eggs, pork, cropping, and horticulture. And I still have some background noise. Di, have you got your microphone off? Can everyone just check their microphone for me before Stephen gets on? So look, sorry about that, Stephen. Over to you. Thanks.
No worries. Hi, everyone. Hopefully you can hear me okay. Thanks for the invite, and good to be able to give an update today. We're going to take a bit of a step back compared to some of the first presentations have been sort of subject specific. I'm going to just talk about general moves that have been happening in the carbon market and the carbon space in the last 12 months since we caught up last time. There's a lot going on in this space, so it's worth really just trying to pull it together every now and again. In terms of who we are, in case you haven't come across Integrity Ag before, we're based out of Toowoomba, but we have staff working nationwide. And work across environmental regulation, sustainability assessment, carbon offsets and carbon insets, carbon footprinting, emission reduction plans, decarbonisation, all that sort of work. And then across all major ag industries. So thanks for the invite, Ange, before. Yeah, like I said, I'm going to take a bit of a step back. So what's driving everything in this space? Well, first, obviously, we have major government targets, and I'm going to speak about that in a moment. We have a 43% emission reduction target between 2005 and 2030, and then net zero by 2050. And then this year as well, the federal government's aligned themselves with a 30% methane pledge, which is a reduction in methane 30% between 2020 and 2030. So that's one major driver in this space. Another one is investors and finance. So I think many people on the line, you may well be hearing about this from your bank as well. And some banks are progressively more and more engaged in this space. And there's a few drivers behind that. And these are global initiatives that are worth knowing about. So the first one's the Task Force for Climate-Related Disclosures. And the second one, similar actually, Task Force for Nature-Related Disclosures. These are initiatives that are driving the finance sector and the corporate sector to act, to understand their emissions, not just in their own business, but also for finance, what they call the financed emissions, so the emissions associated with everybody they loan to first assess and understand, and second, reduce and take them towards net zero by 2050 as well. So major sort of actions. Now, for most of us, also we're selling a product into the market, and ultimately there's pretty significant drive, certainly ramped up in the last 12 months, and we'll see it even more in 2024. For those who buy our products, want to understand what's called their Scope 3 emissions, so emissions from products that they purchase. Many have set emission reduction targets. Many have signed up to that little acronym there, the SBTI, Science-Based Targets Initiative. I'm going to touch on what that means because it's pretty relevant if you're selling products to into the supply chain. Many companies have signed up to that. Zero deforestation, so it goes along with SBTI, and is a big theme we're going to hear about more and more in 2024, and nature disclosures as well. And then private producers, I guess us, what's our place in this? Well, all of us, I think, want to be sustainable and profitable. And I guess with the major market ructions and change in seasons have thrown some challenges into this space for sure. Certainly with prices jumping all over the place and nothing like the profitability in the grazing sector, certainly this year than there was last year, is a consideration. And another thing is, we've heard a lot, especially from the carbon market, that we have carbon assets on farms and we can assess them, we can monetize them. We're hearing more and more and more that we also have carbon liabilities, which is to say our farms and enterprises generate emissions, and our customers, our banks, the government all want us to reduce those as well. So there's a new consideration that we have to take into account where assets are great, but if you have liabilities, you need to balance the two up. And that will extend into nature as well, nature assets and liabilities, which I think we'll continue to hear more of in the next couple of years. If you look at what all this is driven by, many of you have seen this before, but it's important to just understand why is all this happening. Really back in 2015, global governments, through the Paris Agreement, the COP process, which is happening as we speak, I guess, in Dubai, established that to avoid this sort of catastrophic climate change, we needed to stay between 1.5 and 2 degrees warming. And to do that, we needed to dramatically reverse, in the bottom figure there, reverse the trend in emissions, particularly of CO2. And interestingly enough, although I won't major on it here, the Paris Agreement acknowledges that we may not need to reduce methane to zero. It says strong reductions in methane. So for the livestock producers on the line, that's another whole theme, I think, for 2024 is the role of methane and the fact that it may be different to CO2. And there's been more public commentary about that in recent times. But perhaps we only need to reduce methane emissions by, well, 50%, 60%, but definitely not zero. So, and that is aligned with Paris Agreement. So these were CO2 targets, and that's another theme. So what does that mean? Great, we know about that, what the government are doing. Well, the first things the federal government did were to establish the renewable energy target, 82% reduction, 82% renewable energy by 2030. Then earlier this year, they moved on to regulating heavy industry, around about 216 businesses covered by the safeguard mechanism, where they're required by law to reduce emissions or buy offsets if they can't achieve that, sort of on a 4.9% reduction per year, which is actually a lot. And having got those two big, contributors to emissions in Australia off the agenda, if you like, dealt with, the next focus has been agriculture. And in the last 6-8 weeks, we've seen announcements to develop a net emission reduction pathway for agriculture and land sector. So just a quick flag, I won't speak to it in depth, but it is out for consultation now through to the 13th of December. So it's definitely worth a read, and it's definitely worth commenting on. And I will, at the end of this, put the link in the chat. So it's government, investors and finance. Another big move is that through the Corporations Act, major business in Australia are going to be required to assess their emissions, report on them, and set targets and identify climate risks. So really, the net's going to drag wide and capture a lot of businesses. So I think it's likely by that sort of 2026, 2027, almost all the businesses we sell product to ultimately as customers are going to need to be reporting against emissions. So it's a big theme going forward. So you can say it's still getting real. And what I mean by that is there's been a lot of talk, a lot of interest, but now customers and those who buy from us are starting to communicate their expectations, their partnerships as well in this space. And so I think still we're finding it's getting real. It's becoming an actual feature of business. We have talking the grazing sector, three major buyers of product. Coles, Woolworths and JBS have signed up to these science-based targets. So targets to reduce emissions and report against that, both their own business emissions and also the products they buy. So it's pretty significant. It means that it's an increasing feature of production. So out of interest, that sort of path expectation is 2.4% emission reduction per annum for beef. That's the sort of standard. Each company can develop their own specific path around that as well. So, but that's the general guidance. For interest, wheat is 3.6%. So there's a bit of an acknowledgement there that it might be a little bit slower to reduce emissions in livestock, and 72% by 2050. So that's all published. You can look that up in what's called the FLAG or FLAG sector guidance. So it's worth noting Science-Based Targets Initiative. That's what it's all about. Talking about moves in the carbon market space, I think the most significant one in the last 12 months, and will be, I think, in the next 12 months as well, is the integrated farm and land management method. And just a quick sort of snapshot of why that's significant. Firstly, it's intended to be a method that will address really the whole farm, if you like. So we've had up until now methods that will address very specific opportunities, if you like, parts of the carbon account, and nothing sort of tries to do the whole carbon account. And that's the proposed change here, is to cover really the whole carbon account, I guess, is the aim. It'll still probably be modularized in reality, and there might be some versions before it gets there, but that's the intent. It also aims to overcome some problems, like the fact that up until now you can't have a tree project and a soil project on the same piece of land, identical piece of land. So you can't have a soil project underneath the trees. And that's a problem because trees do tend to have higher soil carbon levels, so you will be building soil carbon up until now, not able to account for it. So that's definitely aiming to address that sort of gap. It will replace the HRR method. I guess another big shift that's happened in the last 12 months is that human-induced regeneration, which is really the big big method in the carbon space, delivering around 45% of abatement, was retired by the federal government in September, and there's no real major regeneration method at the moment pending the integrated farm and land management method. So it's very significant, and it'll be pretty interesting in the next 12 months. There's also probably the flexibility there to move away from some of the hard and fast rules that have been in the carbon market. Possibly, for example, it might be able to cover carbon sequestration in what we call sparse woody vegetation, or more scattered trees rather than heavy forests. So that's just a possibility that is opened, which I think is good, because it might be a little bit more conducive to running livestock and building carbon rather than a sort of an either-or. There's an intention there to integrate the livestock, so beef herd management method into there. I guess the only reservation I have about that is if it becomes bigger than Ben Hur, it might take a long time to get through, and it might be very complex to implement. So if we got it through with the vegetation and soil, I think that would be a pretty good outcome. I guess the other big trend I'd just point to is insetting. And this has seen some progress in the last 12 months. I think it'll be a trend, big trend for 2024. Without labouring it too much, but we've heard a lot about offsetting for 7 years. Carbon farming sort of synonymous with generating offset credits in a lot of ways. And there's some reasons for that. You know, you can generate and monetize carbon, you can sell it. That's great. Certainly state governments have used that program as a mechanism to drive abatement and to pay for it directly by the taxpayer, and so is the federal government. And, you know, we've all heard a lot that can generate income streams and so on. But I mentioned this right at the beginning of the presentation. We do have another need, and that is, as ag businesses, our banks, our customers, and now the federal government are telling us we don't just have assets that we can sell, we have liabilities that we're going to be responsible for, or emissions. And so I think there's a whole, you know, shift coming along in a big way in 2024 around being able to account for removals and attribute them to our own carbon account. And we call that insetting. So the purpose is not to generate a credit and then sell it to another business. It's just to verify that it happened and be able to account for it against our own carbon account. So the interesting thing here, there's been plenty of talk for a while about insetting. It's kind of catchy phrase. I say it's leaving the Wild West, and why I use that phrase is we need to formalise that process and quantify it, rather than lots of random ways that people sort of use to quantify insetting. And we've been working with the Climate Active as one of the federal government departments to develop insetting guidelines. They've been out for public review, internal government review, and we're certainly hopeful at this point that they'll be released by first quarter next year, March or so next year. That's the hope. And that'll give, you know, clear sort of government guidance on how you do insetting. Started with tree planting because it's a bit easier, to be frank, and we need a bit more than just tree planting for sure, but it's a good starting point. So I won't take too much time going through this, but, you know, the purpose is really just to verify what is happening on farm with tree planting, and it removes some frustrating limitations that existed in carbon offsets. One is the newness test is not applicable actually under insetting rules, so we can account for carbon in trees that are planted back 20 or 30 years. Provided they're still growing today, we can account for the sequestration that occurred in the last 12 months. So we don't go and retrospectively account for it for 30 years, but if they're still growing, we can add it to the carbon account. Ultimately, uses the same sort of verification methods as the ERF, so it's not some wild and wacky new thing, but it strips out the anomalous sort of things that were required for offsetting. We think on balance there that'll streamline that assessment hopefully reduce costs by anything up to tenfold, which is, hopefully a good outcome. So it should be useful, we think, in smaller plantings, smaller areas of plantings. If you dip your toe in the water with offsetting, with tree planting, you realise that even 100 hectares is, you can almost say, a small planting for offsets, and that's far beyond what most landholders can contemplate. So we think this will be applicable at much smaller areas than that. So where's this all up to? Back to the integrated farm planning method. And the aim has been set for June 2024. It's been a slow process, so we'll see. But it should be out in this year, and there's a discussion paper out on that you can access to keep up to date on it. So take our message. There's a lot happening in this space. I encourage you to engage, certainly in the ag sector emission reduction discussion, and probably to expect that you'll hear more about your supply chain and their interest in carbon in 2024, that insetting of the accelerating trend in 2024, that IFLM has a potential game changer in 2024. So they're I think the interesting and exciting things happening in the space. Back to you, Ange.
Thanks very much, Stephen. Once again, very thought-provoking. I guess the thing I took away from that is that, yes, as Stephen said, I mean, there's a lot in that, but we do have more increasingly assets that we can sell. But the question is, the management is that coming behind that is that we'll have liabilities that we're responsible for over time. So I think what this is all about is just being as informed as we all can. So thanks for that, Stephen. Our next speaker is Andrew Jones. So Andrew wasn't on our webinar last year, but he has done a webinar with us this year. Andrew is a partner with BDO in Brisbane. He's a member of the BDO Food and Agribusiness Group and practices as a taxation specialist. Taxation is an important concept in this whole carbon question, as I learned earlier this year from Andrew. Andrew's clients include primary producers and renewable energy generators. He also advises on the tax implications of carbon credit generation and offsetting, and he has been involved in quite a few conferences and webinars over the last year or two. So please welcome Andrew Jones to speak on the tax implications of the carbon world. Thanks, Andrew.
Thanks, Ange. Just want to make sure that my slides are visible and you can hear me okay.
You sound good and your slide looks great, Andrew. Thank you.
Very good. Thanks very much. And look, thanks so much for the invitation to come back to this webinar. It's a privilege. I know that there's plenty of alternative speakers you could have approached to talk about the business and financial implications of ecosystem opportunities. And by that, I mean carbon farming, but we'll talk about a couple of other points. But I'm glad that you asked me. I'm conscious that I know about what BDO is, but many people do not. BDO is a large accounting firm, accounting and advisory firm in Australia and indeed throughout the world. So we practice in all areas of accounting and business advice. Is this advancing? It is advancing. That's me. It's basically what Ange just said. My contact details are there on the left-hand side. I think that the slide presentations will be sent out after the event, so you can have a greater look. We acknowledge the Aboriginal and Torres Strait Islander peoples on the call. I'm presenting today from Brisbane, which is in Yagara and Terrible country. So acknowledge traditional owners today. Taxation. I've got this disclaimer here. Obviously, taxation is complicated. Anyone who tells you otherwise is lying or delusional. But in addition to the tax disclaimer, the financial services disclaimer, I think, is important. So carbon credits are a financial product under the Australian Financial Services Licensing Regime in the Corporations Act. I'm not licensed to provide advice around the decisions on carbon credits. So nor should this presentation be taken as such, but it is an important point because make sure that whoever you're dealing with in relation to transactions involving carbon credits has that authorization. Okie dokie. So the agenda today is action-packed. I'll be speaking about as I said, the tax implications of carbon farming. And I'll touch on some of the commercial and accounting considerations that emerge from carbon farming and associated land uses. And if time permits, I'll go on to speak about the tax implications that we see from biodiversity. So without further ado, I used to have a slide that went through what an ACCU was and about the carbon farming initiative and a little bit of the history around the Gillard government and the intervening period, the wilderness years, shall we say, where there was various political fights about what this carbon market would be. But I've taken that slide out and I've just cut straight to the chase. But it's worthwhile, I think, up front, I'll make the observation that the tax law relating to carbon credits in Australia has been drafted from the perspective of a carbon credit is produced and then sold to an emitter. That's the concept. It doesn't deal at the moment with what with insetting, as Stephen's just been mentioning, and Richard earlier in the webinar. Those insetting concepts are not really relevant in the tax rules at the moment. The tax rules themselves also have not extended beyond ACCUs, well, not very far beyond ACCUs, and I'll speak about that separately in a moment. In very broad terms, ACCUs are not capital gains tax assets. They are a specific type of asset for the tax rules. They are taxable when the ACCU is sold. So an ACCU which is acquired under a carbon farming project is essentially issued for free, although there are costs involved in that free issuance. But there's a valuable ACCU created. The gross proceeds from selling ACCUs are taxable income in the year that you sell the ACCU. There is a thing called the rolling balance mechanism, and that taxes unrealised gains and allows a deduction for unrealised losses year on year. I've got a note there, the rolling balance mechanism does not apply for individual primary producers from the 1st of July 2022 under some recent law changes, which I'll speak about a little more in a moment. Costs relating to ACCUs are generally deductible. What do I mean by that? So things like the cost of an audit under a method, or the cost of obtaining an ACCU, soil samples, cost of registering for the ANREU, Australian National Register of Emissions Units, transaction costs. Those costs are generally deductible. What about the costs of undertaking a project? This is a more bespoke area. Generally, the deductibility is that those costs are deductible. There are some exclusions in the tax law that say that you can't get to tax deductions for certain things, private costs and costs which are capital in nature. In the context of primary production, it's generally likely that most costs which are incurred in a project should be deductible in the year that they're incurred, or if not in the year that they're incurred, then spread over a relatively short time frame. But individual project costs should be considered. There's specific rules, as I say here on the slide, that apply to the transfer of ACCUs upon the death of a holder, assuming that the holder of the ACCU is an individual, and disposals outside of the ordinary course of business. So in summary, an ACCU in Australia, a regulatory unit, is personal property. It can be held, it can be disposed of. Proceeds from selling the ACCU are taxable while the ACCU is held. If it changes in value and you're not a primary producer, or you're not an eligible primary producer, then that change in value is either going to be taxable if the value goes up, or it's going to be deductible if the value goes down. Simple, some would say. There is, as Ange mentioned, an earlier presentation that I did earlier this year. I believe that recording is available on YouTube for a deeper dive into some of these rules than I have time for today. Should you not be able to sleep and you'd really like to listen to me talking about tax. So the changes that recently occurred for primary producers amendments to the tax law were enacted in July 2023. Broadly speaking, the changes make income from selling ACCUs primary production income. Say, well, why do we care? Primary production income is important to farmers, as any primary producer on the call will understand, for the purposes of the Farm Management Deposit Scheme, which is a scheme which is available for individual primary producers. Primary production income from a tax perspective is also relevant for the primary producer average tax rate regime, which exists in the income tax legislation to smooth taxable incomes over periods of many years, but only in relation to primary production income. So there was an open question as to whether income from carbon farming was primary production income. That question has been resolved by these amendments. There's a few rules which I won't go into in great depth here, but suffice to say that there must be a primary production business carried on by the individual or by a trust that the individual benefits from, and that the primary production business is carried on land which is connected with a carbon project. It's important to highlight here that if a company carries on a primary production business on land that an individual owns, which can be a situation which we see in some farming businesses, these rules don't apply to the individual. So there's a little quirk that to have an ACCU sale produce primary production income, the primary production business has to be carried on by an individual, as I say here, alone or in partnership, or by a trust that the individual benefits from. Another question which we see potentially emerging from this is the connected with rule. The primary production land and the carbon project land need to be connected with one another. The legislation is not prescriptive as to what that means. And so the intention, I think, of the Parliament when they drafted this amendment is that adjacency or nearby land is what they had in mind, although the law doesn't specifically say that. It's slightly less clear what it means where the land is some distance away from the primary production land, but nevertheless under the same ownership and management. Is that a sufficient connection? Time will tell as to what that is interpreted as by the tax office, but for their credit, in the guidance that the tax office has put out to date, it seems like these amendments will be applied on a fairly pragmatic basis in terms of establishing when a primary production project is sufficiently connected with primary production. The carbon project is sufficiently connected with primary production land so as to be eligible. I mentioned that the rolling balance mechanism is turned off for an individual primary producer, and it's important, this final point. I appreciate there's a lot of words here and it's a little bit archaic, but this is a very important point. Whilst sales, the income from selling an ACCU can be primary production income if it's distributed through a trust or comes via a partnership into the hands of the individual. This rolling balance mechanism change, so the change in value of the ACCU is not taxed or it's essentially disregarded. That is only relevant for individuals. So if we have a situation where a trust owns an ACCU because it's the holder of the ACCU in the NREO account, unrealized gains and losses still have tax implications for that partnership, which from a tax perspective means that the individual partners have those tax implications, but they're not able to disregard the change in value. So a little quirk coming out of that. The rolling balance mechanism is switched off only for individual primary producers who hold eligible ACCUs. The other thing here to draw out before I quickly speak about arrangements with carbon service providers is the ACCUs that these rules apply to are ACCUs which are issued on or after the 1st of July 2022. So it's not, there's no grandfathering of ACCUs in existence prior to the 1st of July 22 into these rules. It's only ACCUs which are issued on or after the 1st of July 2022. So that's an important point to be aware of in terms of how ACCUs are tracked. It'll come back to an information management exercise, I dare say, where ACCUs are tracked as to when they were first issued and what that means for individuals' taxable incomes. Carbon service providers. Okay, so we've got a carbon developer that has they're the registered entity with and the ACCU gets into their ANREO account. So what might happen in arrangements like that, where the carbon developer receives the ACCU first, in an ACCU sharing arrangement, or in a profit sharing arrangement, the income that the primary producer books or receives from the carbon service provider should ultimately be treated the same way as if the primary producer had derived it in their own right. That's essentially what these rules do. Basically, it says if there's an individual primary producer who partners with a carbon service provider, then the income that they receive from the disposal of those ACCUs is treated as primary production income, regardless, as long as it would have been primary production income had the individual received the ACCU in their own right. These concessions don't apply where the payment is in substance a lease or a payment for a lease of land. That's going to be dependent on the agreements with each carbon service provider and carbon and land access arrangements, looked at on a case-by-case basis. All right, so to round out the tax conversation on carbon farming, we have been talking about ACCUs, and it is important here that we're only talking about the tax rules applicable to ACCUs. As I said before, the tax rules haven't extended beyond ACCUs. They do, in the legislation, talk about Kyoto units. I'm not aware of there being any current issuances of them. Recent amendments have included safeguard mechanism credit units. Obviously, that's not going to be relevant for carbon farming per se. The more common schemes are around Verra Gold Standard, voluntary methods, ISO certification. So those credits are not covered by the tax rules that we currently have. This leaves a gap. And whilst it's probably right to say as a rule of thumb, most of the time it's going to be the same, it's not necessarily going to be the same tax outcome all of the time. So to the extent that anyone is looking at those other sorts of projects, give your friendly tax advisor a call, or if you don't have one, call me and we can have a chat. In-setting. So a very good conversation on this webinar so far about in-setting, and it's an interesting one because if we're looking at a supply chain, the concept of in-setting, it may actually require the creation and cessation of holding of an offset to offset one's product into a supply chain. But if we're looking at insetting, I appreciate that the definition of insetting has per se changed over time or has become clearer. Insetting merely as a reduction in one's own carbon account has no tax implications under the ACCU rules. Now, should there be, and this is an interesting philosophical point, and perhaps the government would like to grapple with this, should there be an incentive provided to landowners to inset? I believe that there should be. Some way through the tax system would be valuable. However, that remains to be seen, but I'll mention it here that insetting is not currently, to my mind, adequately dealt with in the tax legislation. Succession planning, as I say, ACCUs are personal property and they can be part of your will. So to the extent that we have individual ACCU holders, it's important to ensure that they are included in one's succession planning. The point about pre-entry tax planning and state tax is a little bit difficult without going into an individual state-by-state requirements. But in summary, primary production land in most states is eligible for a land tax exemption. So states don't tax the land under the land tax rules. it is the case currently in Australia that the various states consider what is primary production activities based on the definition in the Income Tax Act for the purposes of working out whether there's a land tax exemption. Unfortunately, carbon farming is not a primary production activity under the Income Tax Assessment Act definition of primary production, which means that a carbon farming project on land may actually void the land tax exemption. So, as I say, it's a specific state-by-state analysis. Take advice and consider whether the land on which the carbon project will be held is in the right structure prior to proceeding. Interaction with other offset and credit schemes. We spoke briefly about voluntary units, other credit schemes where we staple together carbon offsets and biodiversity credits or other co-benefits. The tax rules really only apply specifically to the ACCU. Any other credit has to be considered on its own merits. And the CGT rules before, as I said, ACCUs are not CGT assets, which means that they cannot get things like the 50% CGT discount or the small business CGT concessions. It is a question that comes up from time to time. Okay, I'm conscious of time and I am galloping through. As much as I enjoy tax, I will speak briefly about the financial and commercial implications of carbon. And look, the task force for financial related climate disclosures has been mentioned already. That's definitely driving a lot of the commercial awareness. It is certainly in the client base across the firm here at BDO. We're having a lot of conversations with clients who are being asked by their customers to describe their carbon footprint for the purposes of their customers' Scope 3 emissions as people prepare for carbon or climate-related financial disclosures, which for large companies, that those disclosures commence shortly. From a more boring financial accounting perspective, as opposed to carbon accounting perspective, oddly enough, well, maybe it won't come as a surprise, there's no specific Australian accounting standard for carbon credits. So the people who make accounting standards tend to take a long time to do that, and they're still considering how the carbon credit should be accounted for. The businesses that don't need to apply accounting standards, for example, if you're too small, you don't need to apply accounting standards when you prepare your accounts, can adopt an approach to account for them in a way which is most meaningful for the users of the accounts. So I've provided some observations there, but in broad terms, I'd say that for most, well, it depends on the insetting methodologies and the overall business objective, right, in terms of how the carbon credit is created. But it's probable that many businesses would want to see carbon credits, which they've created as assets on the balance sheet, and they would want to bring in income when they monetize those assets by selling them. But it depends. We're certainly, as I said, seeing supply chain requirements coming down the chain. Carbon projects are increasingly well understood by banks and valuers. I think this is, I was recently speaking with a banker who was talking about the ins and outs of soil carbon. Well, if that doesn't indicate that the banks understand carbon projects, then I don't know what does. The observation that I'd make is that maybe the depth of understanding is not great. And some of that may be driving some interesting kinds of conversations. This is just my observation, but at least there is an increasing understanding of carbon projects amongst banks and valuers. Very briefly, once you own carbon credits, what's the best way of marketing and selling them? Carbon neutrality product claims. These are all other themes, but they, as I said, I can't give advice on the marketing and sale of carbon, but once you have credits, you may want to be choosy as to who you sell them to. For example, you may not want to reduce the offset or offset the emissions of a gas company, for example. These are all commercial thoughts as to how one seeks to monetize one's offsets. I think I am basically out of time. Very briefly, around biodiversity, it will not surprise you to understand biodiversity is not taxed very well under the tax law at the moment. similar to things like voluntary units, there's no specific tax rules which apply to biodiversity. There are specific tax rules which apply to conservation covenants, which are generally speaking a feature of biodiversity, biodiversity credits. But it takes some pretty industrial strength tax analysis sometimes to work through biodiversity schemes to work out what the tax implications are. I'd say that it's reasonable to expect a similar outcome as to carbon credits, specifically ACCUs, but again, it's not 100% clear. So phone a friend. Okay, so the rest of the slide content is about BDO, our sustainability services. I'll leave you to consider that once the deck comes through. I just did want to call attention to this specific webinar series slide. If anyone wishes to understand things like task force for financial related climate disclosures, measuring greenhouse gas emissions, setting boundaries, etc., BDO has a full webinar history, and we'd be pleased to share that with you. That's me, Ange. Thank you very much.
Great, Andrew. Thanks so much for another interesting spiel about tax, as if tax and managing agricultural businesses wasn't complicated enough, and as if succession planning in agricultural businesses wasn't complicated enough. And I can see Jules Roberts smiling at that. Look, thank you. And I, as well as these recordings, I will send out the recording to Andrew's webinar from earlier this year. It really was a very interesting webinar. So we'll be giving you lots of homework that you can do, or, you know, that you can go back and review, because Andrew had to gallop through today. And we'll also send out, there is a cheat sheet, I suppose, that BDU has developed, just to give you some briefs around the tax around these things. And as Andrew said, look, he did say that I guess the taxation industry, is it an industry? Taxation needs to probably take a closer look at insetting, for example. It's an evolving thing, isn't it? So, and biodiversity will be the next one, won't it? So, look, thank you very much. And Andrew will be here, obviously, after we finish. We'll have a bit of a question time, and you'll be able to get Andrew's details if you need to get in touch with him for further questions. So the next person that we'll be presenting is the very incredible Melanie Leather. She is an amazing woman who's a great spokesperson for our industry, a very clever woman. She's a wonderful livestock manager. She's also very smart, good spokeswoman. Her and her husband, David, have a property in central Queensland out near, sorry, not David. What did I call Rob? David. Mel's husband is Rob. And they're in central Queensland up near Banana. And they, with their son and daughter-in-law, run the Leather Cattle Co., which is a family-owned beef cattle enterprise. They have 3 properties that span 17,500 hectares, and they're currently running about 5,000 head of cattle, where they breed and finish for organic, EU and nature pasture-fed markets. Melanie's been actively involved in sustainability, advocacy and policy on behalf of the Australian beef industry over the last 16 years, and was recently awarded Australian Biosecurity Award in 2019, being named the Farm Biosecurity Producer of the Year. MLA actually sent Mel over to Dublin, I think that was last year, wasn't it, Mel, to be a spokesperson for our industry. And as well as all of that, and being a great woman to have a wine with, Mel can also make amazing gingerbread houses. So anyway, I'll hand over to you, Mel, to let us know about, I guess, the producer perspective around this ever-changing world, this carbon world. Thanks, Mel.
Thanks, Ange. And look, it's such a pleasure to be here today. And what a great lineup of speakers we've had so far. And I've learnt so much already. Just amazing people to listen to. As Ange has probably, she's covered pretty much what we do and how we operate. We do have a soil carbon project registered, but we're by no way experts in soil carbon. And, I've picked up a few tips here today. We've registered that project ourselves, though, so we haven't used a service provider. And so we've learned a lot of things along the way. So today, just to set the scene, I'm going to start with a brief snapshot of some of the stats on the beef industry. I'm going to talk about what do resilient ag investments look like from a producer perspective, as Ange said. What are some of the efficient practices and technologies that might help us to maximise ecosystem services in our business? Touch a little bit on carbon literacy and decision making and why that's important for us. Carbon sequestration solutions and what we need to think about around reaching decarbonisation targets, and future opportunities for Australian agriculture as I see it. So as I said, to set the scene, Australian beef cattle producers are stewards of over 50% of Australia's land mass, and we play a critical role in managing land and water assets for future generations. So adapting to ecological challenges in a changing climate is crucial, not only for a sustainable future for farming, families and community, but it's vital for future global food security. And as Ange said, going to Dublin last year really highlighted that for me. So adopting new practices can be daunting for a business, especially when navigating complex environmental system decisions, multiple service providers and their competing marketing claims. The red meat industry really set a bold target to reach carbon neutral by 2030 back in 2017. So we really have led the way. We have reduced emissions by 64.1% since the 2005 baseline, and we have 43.7% of grazing land being actively managed for biodiversity. So this shows that our role is critical in reaching decarbonisation targets, and we hold solutions for carbon sequestration. So how do we maximise our opportunities and decide what investment will give us our biggest bang for our buck? It's important to identify the priorities for your business and understand the best management for your environment. So engaging experts to complete feasibility studies helps to make informed decisions around this. And people like Steve from Integrity Ag are the types of companies that we can call on for that. So doing a baseline assessment also gives you a starting point and solid data to make informed investment decisions. If we look at our 3 properties, we've got 30 different regional ecosystems and 14 different land types. So we need to take a really tailored approach, as each of our properties require different management and on-ground practices. But the principles are basically the same. We need diverse management systems to conserve and enrich soils. And if we look at the Food and Agricultural Organization of the United Nations definition of soil health, it's the continued capacity of soil to function as a vital living system within ecosystem and land use boundaries, to sustain biological productivity, promote the quality of air and water environments, and maintain plant, animal, and human health. So this leaves us in no doubt that healthy soils are at the core of our business's capacity to be resilient. We also know we need a diversity of species and animal impact to have resilient pastures. We know that advancing the development of new crop and livestock breeds that are weather and disease resistant, require fewer inputs and have higher yields will build our resilience. Our climate is getting hotter and drier, and already the whole planet is experiencing extreme weather events. So we need to think about how we will manage more extreme fires, floods and droughts. How will we reduce emissions? How will we sequester carbon in our soils and vegetation? These are all questions that we must seek the answer to. With a growing global population, the demand for animal protein will increase. But with increased livestock numbers, there will be increased enteric methane emissions that we will need to mitigate. As temperatures rise, we will see a geographical shift of pests and disease vectors. This will affect food safety, human and animal health, and trade barriers into some countries. So what can we control? What efficient practices and technologies can we implement? And as Richard stated earlier, we need to be at the head of the queue by being the most efficient farmers that we can. As I said earlier, genetics plays a significant role, and I think Richard touched on that as well, as does increasing reproductive and growth rates and reducing mortalities. These practices not only reduce our methane emissions, but they also increase our productivity. Grazing land management through rotational grazing or resting paddocks, spreading watering points to even out grazing pressure, and introducing legumes such as Leucaena and Desmanthus. Feed additives aren't readily available to those of us in extensive grazing systems as yet, but certainly there are some feedlots using them. But as an industry, we want to see the cost and availability be practical to everyone. I think this is a space we need to watch, and research and development continues to evolve. We will hopefully see cost-effective, safe and practical options available to us. For those that use fertiliser, we need to ensure that this is done efficiently, make informed decisions through soil and plant sampling, use the right fertilisers at the right time, at the correct rate, and ensure it doesn't run off. When I look at our properties, we're all situated in the catchment of the Great Barrier Reef. So this is critical to not only be out for our efficiency, but it's a regulatory requirement as well for our business. So efficiency of fuel and energy use, ensuring our buildings and machinery are as efficient as possible. And renewable energy. This is an interesting one because we can definitely use renewables as an emission reduction strategy. And this can also save us money as it reduces or removes electricity bills. One of our properties is 100% solar powered, and I don't think there would be a producer around that doesn't use wind or solar for pumping water. So this is an area that most of us are working in already. On the flip side, Barfield is situated in a renewable energy zone. So we are faced with solar and wind farms competing for land use. The decision then becomes, do we take advantage of diversifying income by signing up with wind and solar projects? Or is it a better option to have policy that renewable development must incorporate agricultural production into the design of these farms? And Ange, this will be a whole new webinar for you. But we need to start seriously thinking about the role of agrovoltaics will play within agriculture. And for those that don't know, agrovoltaics is using the same area of land to obtain both solar energy and agricultural products. I think for those of you in the south, this has probably already started, but certainly here in central Queensland, in regards to solar farms, it isn't common. And given the Queensland government has announced a 70% renewable target by 2032, as part of the $62 billion Queensland Energy and Jobs Plan, this is a space we will need to have a strong voice in. And for a strong voice to be effective, we need to understand and be literate in carbon. And for our businesses, this will be vital for decision-making going forward. So we need to ensure there is a continuous path of education. And we are fortunate that we have some very clever people developing training and support in this space. Just to name a couple, the University of Melbourne has a carbon neutral ag training program, and MLA will soon start the new Carbon Edge training, which will help to take carbon from a concept to an action plan. We're starting to get a suite of resources through MLA, government, tertiary and private providers. Yesterday, I sat through a presentation from Ruminati, and Ruminati is an online emissions calculator created by farmers for farmers, helping producers across Australia track and validate on-farm climate action across the supply chain. It's a good example of the many tools that are now available to us. For us as producers, we need to be proactive and connect with available programs and tools that suit our individual businesses. Not every tool or program is going to suit us, but somewhere out there, there'll be something that fits in with how we operate. So we need to collaborate broadly and take advantage of peer-to-peer learning. There's nothing more powerful than checking out what your neighbour is doing, as generally they have made all the mistakes and learned all the hard ways. And often over a chat at a barbie and a beer, it's more productive than sitting through a workshop. So we need to engage experts to do a cost-benefit analysis, preferably someone who can give good advice backed by science and doesn't have a vested interest in the outcome. And finally, measure, monitor and record. We can't find solutions if we don't know what our starting point is. So carbon sequestration solutions and reaching decarbonisation targets. We not only need to do these solutions to meet our business needs, but on top of this, we have national and international policy drivers and targets that impact us. And, Richard and Stephen really covered this well today, particularly Stephen's explanation of it. So I'm not going to go through it. And look, when we look at those decarbonisation targets, it's a little bit overwhelming. But, you can see here, and from what Stephen's told us, we've got a lot to think about. And it's something we can't ignore. So whether it's meeting our own business requirements or in some case our investors' needs, customers, consumer needs, our banks or global agreements, we've got to be prepared to find and implement methods to improve carbon sequestration. And some of these solutions include increased vegetation, planting trees, avoided deforestation. Now, once again, this has to be considered at a property level. What will suit one area won't suit another. In our business, we're planting tree corridors linking remnant vegetation on Barfield. We've been assessing feasibility of avoided clearing and human-induced re-veg on Hazeldean. But after listening to Stephen's talk, I think we're going to have to consider looking at the integrated farm and land management method. So that's something extra for us to be looking at. But on the 4 Mile, we've got a silver pastoral project. So, and that's really demonstrating livestock productivity, environmental service, and the benefit of trees. So 3 different properties and 3 completely different methods that we're looking at. So there's definitely no one size that fits all. We've introduced legumes. Once again, it's got to be tailored to suit the region. We have used Leukina and Desmanthus on Barfield, and we've had to use other legumes at Hazeldean and the 4 Mile. So healthy soils and increased soil organic matter, and this can be achieved through dung beetles, reducing cultivation, retaining crop stubble, importing carbon using products like biochar, manures and composts, and grazing management. Looking at the duration and intensity of grazing, we want to increase biomass and encourage plant growth and root depth. We want to aim for a diversity of species, including legumes. And in a lot of cases, producers are already doing this and have done so for many years. And there are plenty who have got good data and evidence to back this up. But for those of us who haven't, now is the time to start. Use the tools and technology available and start baselining your business today. I like to think of the opportunities rather than focus too much on the challenges, but it's important we identify the challenges, but I would rather work on solutions and take advantage of the future opportunities in Australian agriculture. I think we all want to contribute to climate solutions. Besides being the right thing to do, the impact on climate change to our business is significant. We need to address that sooner rather than later. We want to build resilient, improve biodiversity and enhance soil health, because that is good business and we want to be here for the long haul. But the co-benefit is carbon and natural capital benefits, and we must understand that. Insetting it will help our market access and will improve terms with financing and insurance. And once again, Stephen and Richard really clearly set that, how important that is for us as producers to get involved in that. Then again, offsetting, as they talked about, allows us to diversify income streams. But once again, we need to have the resources and the tools to make informed decisions around that insetting, offsetting. We need to mitigate market barriers by leading the way on climate. And as I said earlier, agrivoltaics, let's get the policy right and make this a non-negotiable when it comes to government approving renewable energy projects. And I'm just finishing off here. That's a photo on Barfield of the Integrity Ag team doing some soil sampling for our soil carbon project out there. So looking really dry in that photo. We have had rain. It does look greener now, but I haven't got any nice fresh new photos. But thanks, Ange. Looking forward to questions.
Thanks so much, Mel. And what a wonderful and beautiful part of the world you live in. Look, that was great. And I'm hoping everyone is feeling inspired like I am. What an amazing industry we work in, and what an amazing bunch of people we've got presenting today and also actually listening into this webinar. So look, I'll just read out one question that we've had, and I'm sure there's more that would come in, but one that came in, this is for you, Andrew. Of course, it's a tax question. Oscar asks, some methodologies have seen significant land asset value depreciation on either whole farm area or area encumbered by a project. What are the taxation implications on pathways that this opens? Should the landholder consider selling such land? It's probably not advice you can actually give on a webinar, but
yeah, I mean, thanks, Oscar, for the question. I think it's a really interesting point. So, as I think most people will probably realise, the permanence period for carbon projects, be it 25 or 100 years, continues on against the title of the land, and therefore must continue to be the project in essence continues to be conducted post land transaction. So in some quarters that has reportedly led to a decrease in the value of the land. Now, I have heard recently that as carbon projects, and particularly the monetary benefits of carbon projects, has become more well understood, that trend may be reversing, slightly outside my wheelhouse in terms of whether properties are trading at a lower value. But in terms of tax implications for devaluation of land from carbon projects, in short, there aren't any specific areas where we get any kind of benefit to say that the land has diminished in value and therefore there should be some reduction in a future capital gain or loss situation. A couple of areas that the tax office has ruled on which are of interest in property transactions with carbon projects. The carbon project itself can be a CGT asset. So whilst the ACCUs are not CGT assets, carbon project areas can be a separate CGT asset and can be transacted under the small business CGT concessions. So there are a couple of rulings on that are publicly available from the ATO's website. It's not an area that I've personally had anything to do with, but as I say, I'm aware of it. But as I say, in very summary terms, where a property does devalue because of a carbon project, that's essentially reflected in the final sale price and may give rise to a lower capital gain or a capital loss, all else being equal. I'm not sure whether that covers it off, Oscar, to your satisfaction, but that would be my comments.
Great. Thanks, Andrew. Look, they're complicated ones, and obviously everyone needs to understand. They need to go to their tax expert and ensure that tax expert actually understands the carbon industry, which is something that Andrew made really clear on his webinar earlier this year. Look, I'll just grab another question. This one's to Warwick. I know that you did answer this sort of in the message, Warwick, but did you want to comment on the ideal depth for soil testing and just there's a lot of questioning around that, isn't there, Warwick? So do you want to just answer that one for us, please?
Yeah, I think the easiest way to answer it is if you're looking at doing a carbon credit project that's consistent with ACCUs, you need to go to a minimum of 30 centimetres, and that's also with IPCC protocols. So most schemes are going to require to go at least 30 centimetres. Going deeper, it really, I think you have to review the cost about that, and that's why I didn't give a definitive answer in there about what is the best depth, because you actually need to understand the costs of the extra samples, and we know from our own sampling that it's a lot slower to get out cores to a metre because you generally strike conditions that are not favourable to coring, such as rock or heavy clay, which can really slow down that coring process and just the time. So what I would say is you're better off getting more at 30 centimetres to get a higher accuracy that might show that you can actually show a change. Whereas if you're getting fewer that are deeper, then you might not have the same level of accuracy, and so you might not see the change. So that would be the way that I would look at the problem. And then you could work out what the additional carbon might be worth down to that depth, assuming a decreasing proportion compared to changing the surface as you would go down the profile. But generally, we wouldn't expect to see much change below about 70 centimetres to a metre in soil carbon at all. And it's very difficult to detect change below 30 to 50 centimetres at all. So, yeah, I think some of that might help you with making those decisions.
Thanks very much for that one, Warwick. That's it's always been a tricky question. Look, does anyone else on the call have any busting questions for our speakers, or do any of our speakers have anything they'd like to say in this time? Stephen, did you just get the message that I sent to you, Stephen Wetterman? Stephen might have gone.
Sorry, yeah, just having a look.
And look, and if Oscar, are you still on the call? It's just some comments that you sent through. Are you still on the call, Oscar? I don't know if you want to, if you understood the comment on that, Stephen.
Yeah, I can read it out, and I imagine it'd be interesting more broadly. So Oscar commented, assuming, and this is far from certain at this time, that insetting will not be possible on farm assets utilised in the ACCU offsetting process because of double dipping. how will this work? How will the frameworks sift through this, and how will that influence insetting it at point of sale with major brands? Will there be a price relationship going on with that? So there's a number of different questions wrapped up in that. I'll comment the first point about insetting and offsetting, and it's pretty important actually to note, so relevant I think to everybody. It goes to reason that if you sell ACCUs or generate ACCUs and sell them to a third party, so BHP for example, you won't be able to include them on your carbon account, so they're going to get deducted from your carbon account. That's the double counting issue. There is a policy grey area with whether you might still be able to include them on your carbon account if you sell them to the federal government, but it's grey. It's policy grey area. Be a great one to comment on in the current ag sector guidance. If anyone's picking up on that and wants to make comment, that it'd be very nice if we could include that on our carbon account, because that would support action. But yeah, you can't sell to BHP and include it on carbon account. So that's the first thing. So insetting sort of removes that, because insetting doesn't formally generate a credit at all. It just verifies the amount of removals on in your business, and there is, it's definitely in the thinking to be able to attribute that to the products that come out of your business. So selling wheat, selling wool, you're selling cattle, and it's all to be determined, but I could see definitely a pathway to some form of monetisation. Not sure if it'll be the same value proposition as an ACCU. It's a different sort of issue, but some sort of incentivisation may well come in that area. It's all, it's all speculative at the moment, but one would like to think that, one thing we need in this whole decarbonisation space is a lot of parties to be able to act together in ways that probably go beyond what they ever had before, in terms of farmers, supply chain, customers, consumers, government, finance sector. We somehow need to find a way to work together, because there's some big mountains to climb, and we definitely need to be able to do that, and not just leave it all as though agriculture or farmers are going to sort it all out. So yeah, definitely want to see that sort of pathway open up. So there can be some form of monetisation and incentive to do that.
Great, Stephen. Thanks for that. I think Richard wanted to add something to that. So Richard.
Yeah, thank you. And the government just recently closed the loophole of selling credits back to government, because they now recycle them. So if you sell your carbon credits back to government, they make them available to safeguard facilities at a reserve price of $75 a tonne. That means you can't sell your carbon credits back to government and still claim neutrality, because they were so desperate for carbon credits to meet the safeguard declining baseline that they had to recycle them.
I don't quite know what to say about that, Richard. Thank you. Anyone else? Thanks
We
for
thought
letting us know
it was
about
safe,
that.
but it's not anymore.
Yes.
Yeah, good point, Richard. And it is a problem, because we need some forms of incentivisation, some ways that the government can work with landholders, and it's potentially there, but not if they go and do that.
I just
There's so much. Yeah, you go, Mel.
Tricky question, Ange, and I've already run this one by Richard, but we've recently had a resource company want to do exploration permit over where our soil carbon project is, and I was wondering if anyone else had come across this issue, and or even Andrew, you might have heard something around that. Just keen to hear if anyone's come across this before and how they've handled it.
I haven't heard of that. No.
So Andrew, it's really, you've got a soil carbon project, and then a mining company comes in and wants to mine on top of that. They've got the rights to mine what's below the soil, but what are what's the damage response of them interfering with your soil carbon project? Did we ever resolve that, Mel?
No.
Adding further questions to the question, hey Mel?
It's a tough one, yeah.
It is. Yeah, look, I think this is what's happening at the moment. It is just such a rolling ball game between 12 months ago when we held this first webinar and today, and all the questions that are arising out of today. Obviously, this is something we need to keep working on as an industry and keep discussing to get these questions answered, because like Mel said, you think you sort of get some carbon questions answered, and then you've got a mining company that wants to come over the top, and how does that complicate everything that's happening? Does anyone have any comments around that? I've got no solutions. But look, has anyone got any further questions for our panel? Because otherwise we can. Okay, we might look at winding up. And look, what I just wanted to say is that, look, I think we will be sending out recordings to all these webinars today. I'll just send them all out in one email so you've all got them, plus recordings to Andrew's previous tax webinar, plus recordings to last year's webinar. So we've all got the information that we need, and you can choose to access any or all of them if you like. Also, you will have my contact details if you want to get in contact with anyone that's on this webinar. I'm sure if you've got questions you want to discuss with them, I can put you in touch with them. I would like just to ask all of you if you've got any ideas, because we run these webinars with these fantastic and intelligent people providing really great information from all different perspectives. The perspectives today I feel like are pretty representative of everyone in our industry, from the producer and with Mel, Stephen, with his environmental management, Andrew, Warwick, Richard. We've got some really great people here, but we run these webinars and I think we will continue to do this. But what's the next step? We all come out of these with really great questions. Do we need to take a next step into doing an online tutorial and just jumping into questions deeper? Do we need to actually get people together in working groups? Do we, as discussed with Warwick and Mel, I think, and Richard the other day, do we need to do more on-farm trials to actually get the data that we need to actually make more informed decisions? I don't know, but what I'm saying is I'd really welcome any thoughts that anyone on this call has, including our esteemed and intelligent presenters, but also our esteemed and intelligent participants, because the way forward is for us all to collaborate with ideas, to look at opportunities, and actually just continue to be innovative, which is what all these people are. So look, thank you so much for attending this webinar. Thank you so much to Mel, Stephen, Richard, Andrew and Warwick. Once again, fabulous people who give their time for free to Landcare Farming so that we can provide this information to you all. We will be doing this again. Bad news for all the VO presenters, but it won't be next week. We'll let you get Christmas out of the way and probably Easter. And look, any opportunities anyone that's on the webinar can see that Landcare Farming can support you with and in, even if it's just a first step of having a discussion, please, collaborate with us so that we can collaborate with you and keep pushing our industry forward. So look, thank you. Like Richard said, plotting the pathway from carbon to biodiversity is the next step to ESG and agriculture. Thanks, Richard. Yep, there's next steps and information and things that we need to do. And then Gordon Williams just said more info from Warwick B relating to the research at Orange on grazing management systems. Yep, where we'll send out the papers, any of the papers that have been released in the last couple of months around grazing management. Also, I'll talk with Warwick and we'll get information and links to you all about Warwick's work, about the work of all of the people, Richard on the call, Stephen's work, Andrew's work. I'll get that out to you. Look, thank you so much, everyone. It was unfair to run this late in the afternoon. I know everyone's probably pretty tired, but thank you so much. Has anyone got any questions before we close off? Good. I'll send an email to you all tomorrow with the information I promised and look forward to catching up with you. Thanks all. Bye-bye.